On October 19, 1987, the stock market crashed 22% in a single day. Phones rang nonstop on Wall Street. News anchors used words like collapse and financial catastrophe. Investors believed the system itself might be breaking. But while most people were selling in panic, a handful of ordinary Americans quietly kept buying through their retirement accounts. They didn't know it at the time. They were buying into the foundation of one of the greatest wealth-building eras in history. From the ashes of that crash, the market went on to compound for decades. Those who stayed invested through the chaos of 1987, the recession of the early 90s, the dot-com crash, the housing crisis, and the pandemic built extraordinary wealth, not because they were brilliant, but because they stayed present. History doesn't reward panic. It rewards positioning. And right now, we are standing at the edge of another historic positioning moment. Not because markets have collapsed, not because the headlines are screaming doom, but because a silent force is reshaping the financial future of an entire generation. The number is staggering. $124 trillion. That is the estimated amount of wealth expected to transfer from one generation to the next over the coming decades. It is the largest wealth transfer in recorded economic history. And like every massive shift before it, the biggest beneficiaries will not necessarily be the people who inherit the most. They will be the people who position themselves correctly while the transfer unfolds. To understand why this matters, we need to understand something simple. Wealth never disappears. It moves. And when it moves at scale, it changes everything. The generation born after World War II built unprecedented wealth. They benefited from rising home values, expanding stock markets, pension systems, business ownership, and decades of economic growth. Now, as that generation ages, trillions of dollars are beginning to change hands. Some of it will pass directly to heirs. Some will go to charities. Some will be liquidated. Some will be reinvested. But none of it will sit idle. Money in motion creates opportunity. It creates rising asset prices. It creates new businesses. It creates demand for housing. It creates demand for financial services. It creates entire industries. When large pools of capital shift, markets adjust, and those adjustments create entry points. Think back to 2009. After the financial crisis, markets were devastated. The S&P 500 had fallen more than 50% from its peak. Fear dominated everything. But that moment became one of the greatest wealth-building opportunities in modern history. From the March 2009 low through the mid-2020s, the market delivered extraordinary returns. Ordinary people who kept contributing to their 401ks and IRAs saw their balances multiply. Millionaire households surged. Not because millions of people suddenly invented billion-dollar startups, but because millions consistently participated in expanding markets. Now imagine a similar tailwind, not from emergency stimulus, but from generational capital redeployment. The scale is even larger. Over $124 trillion will not move in one dramatic wave. It will move gradually, estate by estate, year by year, transaction by transaction. And that steady movement will quietly fuel the next era of wealth creation. Here is what most people misunderstand. This opportunity is not primarily about inheritance. Only a small percentage of households will receive truly life-changing inheritances. The majority will receive modest sums, or none at all, but everyone participates in the ripple effects. When heirs receive assets, they reposition them. Younger generations invest differently than their parents. They have different risk appetites, different technology preferences, different geographic priorities. That means trillions will rotate across sectors. New industries will absorb. Capital, emerging technologies will accelerate. Housing markets in growth cities will see renewed demand. Financial firms will compete aggressively for younger clients. Entrepreneurship will expand as inherited capital funds new ventures. When money moves, ecosystems grow around it. Consider how previous wealth shifts changed society. After World War II, returning soldiers used government-backed programs to buy homes, attend college, and start businesses. That wave created suburbs, expanded the middle class, and built generational prosperity. In the 1980s and 1990s, the expansion of 401k plans democratized stock market participation. millions of workers became investors. From 1982 through 2000, markets surged, creating widespread wealth. After the 2008 crisis, those who kept investing experienced one of the longest bull markets in history. Each period had something in common: a large-scale structural shift, a skeptical public, and extraordinary long-term rewards for disciplined participants. The current wealth transfer fits the pattern, but it feels different because it isn't tied to a single dramatic crash or event. It's slower, quieter, more structural. That makes it easier to ignore and easier to miss. Let's talk about positioning. First, tax-advantaged investing. When trillions flow into markets, broad participation matters more than perfect timing. Consistently contributing to retirement accounts allows compounding to work without annual tax friction. Over decades, that difference is enormous. Second, broad diversification. Trying to predict exactly which sector will benefit most is tempting. Artificial intelligence, healthcare innovation, clean energy, digital infrastructure, real estate in high-growth regions all may capture portions of redirected capital, but owning broad market exposure ensures participation in aggregate expansion. Third, skill alignment. Capital movement creates professional demand. Estate planning, attorneys, tax specialists, financial advisors, real estate professionals, trust administrators, wealth managers. As assets transfer, services surrounding those transfers expand. Positioning your career within capital flow increases income stability and upside potential. Fourth, liquidity. Wealth transitions are rarely smooth. There will be corrections, recessions, forced asset sales, temporary dislocations. Those who maintain emergency reserves can deploy capital when prices temporarily disconnect from long-term value. The best opportunities often appear during uncomfortable moments. Fifth, time horizon. The wealth transfer spans roughly 20 to 25 years. Short-term volatility will not invalidate long-term capital movement. Thinking in decades rather than quarters allows compounding to operate uninterrupted. One of the biggest mistakes investors make is believing they need a dramatic move to become wealthy. They wait for a crash. They wait for perfect clarity. They wait for certainty. But wealth is rarely built through single dramatic bets. It's built through consistent exposure during powerful macro shifts. Imagine someone 30 years old today investing $600 per month into diversified index funds for the next 25 years. Assume conservative long-term returns. Even modest compounding transforms steady contributions into substantial assets. Now layer in a macro environment supported by unprecedented capital rotation. Even small increases in growth rates amplify outcomes meaningfully over decades. That is how ordinary people quietly cross seven-figure net worth thresholds, not through speculation, through disciplined participation. Here's something else important. The psychological environment will not feel easy. There will be political uncertainty, technological disruption, economic slowdowns, market corrections. Media cycles will amplify fear, just like in 1987, just like in 2000, just like in 2009, just like in 2010. Yet long-term capital has historically flowed toward productivity, innovation, and asset ownership. The people who stayed invested through previous cycles didn't have better information. They had stronger discipline. Another overlooked dynamic is the spousal wealth transfer phase. A significant portion of assets will first move to surviving spouses before transferring to the next generation. This creates shifts in financial decision-making. Women will control a larger share of wealth than ever before. Financial services that understand this shift will expand. Entrepreneurs who recognize demographic transitions early will build durable